Quick question. How many people in the world do you think are worth $1 million? It's hard to comprehend, yet over 47 million in the globe are millionaires. In addition, did you know that the United States is home to almost 20 million of them? And wait, I still have another shocking fact for you. To put it in another way, around 700 individuals in the United States alone enter the ranks of the wealthy each year. The path to riches may not be as steep as we've been taught to assume. However, it is well known that learning how to invest is important to becoming rich. Despite widespread curiosity in the stock market, many investors struggle with these questions. Where can I find promising stocks? How do you determine whether a stock is a good investment? When making a choice, most people go to the news first. One might assume that a stock is a good investment if it's gaining in price and receiving a lot of media coverage, or if it's trending on Twitter and vice versa. Sadly, that is the worst way to put your money to work. When it makes the news, you are probably too late. So in this video, we'll take you to the answers to these questions. How to find great stocks, and how can you find stocks whose value will go up over time. If you're new to the channel, hit the subscribe button and that little notification bell icon so that you don't miss out on any of our video updates. Plus, it helps us spread the Thrive Wise love to help more people thrive wisely. Now, let's begin. Why stock prices aren't important. Last year, Apple was worth about $2 trillion, and each share of its stock was worth about 120. But what if I told you that Apple stock was worth about $170 in August of this year? Wow, great, that's awesome. But wait, what if I told you that when this script was written, the price of Apple stock dropped to almost $135? Does that mean the business was worth a lot more back then? Really not. This fact proves Warren Buffett's quote that states, "Looking at the price of a stock is not investing." Now, if it seems too complicated already, don't worry. That's why I'm here. To make things easier for you and make you a pro investor in less than 10 minutes. Rumor has it that my viewers are among the smartest on the site and they learn 10 times faster than anyone else. So, I'm counting on you and don't let me down. If you look at the companies that are traded on the stock market, you can see that they have a price. Since no one can afford that price, they are broken up into many stocks. The most important question is whether or not this company is really worth $768 billion. The answer is no. You see, the words price and value are very different. Every day, the price of a stock goes up and down. Even fake news that is just a little bit bad can make the price go down, but not the value, which is what the company is really worth. For example, Facebook's earnings in July 2018 weren't as high as some investors thought they would be. So the stock price went down from $217 to $176. That's a 20% decline. The company's market value dropped by $120 billion in just one day. Does that mean the company shrunk by 20% overnight? No, of course. So the stock price jumped back up to where it was before the drop and is now 30% higher. So if you want to make a good investment, you need to find out how much the company is really worth and then compare that to how much it sells for on the market. If the price is too low, it's a good investment. But if the price is too high, it's not a good investment. That's all there is to it. Buffett learned about PetroChina in 2002. The business's financial papers indicated the value of at least $100 billion. But the stock was only trading at $30 billion. Given the current political atmosphere and the expectation that oil prices would increase at the time, he saw this as a wonderful opportunity and put about $500 million into the company. What do you think happened? The company's value soared above the $100 billion mark, topping $275 billion. After selling his share, Buffett made $3.6 billion. So the question is, how do you find out how much a company is really worth? The PE ratio, which stands for price to earnings ratio, is one of the most used ways. It means basically how much investors are willing to pay for every dollar the company makes. It's a simple way to figure out if a stock's price is too high or too low. Let's say, for the sake of argument, that Apple made $2,000 this year and has a total of 1,000 shares. When we divide Apple's earnings by a total number of shares, we get EPS, which stands for earnings per share. This means that Apple has made $2 for each share. To find the PE ratio, divide the share price by the earnings per share, which is the EPS. Let's say the share price is $50. In this case, investors are giving Apple $25 for every dollar it makes. In other words, the company wouldn't be able to pay you back for 25 years. Around 15 is thought to be a good PE ratio. If the price goes above that, it might mean the stock is overpriced. One example of a PE ratio is 970, which is Tesla's. Does that mean Tesla's price is too high? Maybe or maybe not. And we're halfway done through the video. So I would like you to do something for me. Pause this video right now and do me a huge favor by hitting the subscribe if you're new to the channel. We would also appreciate it if you leave a small comment on how this video speaks to you so far. Also, please hit that small like button if you see this video as interesting. And going back, when figuring out a company's PE ratio, we look at the last year's earnings per share. But when you invest in a company, those past earnings don't matter. What matters is how much money the company will make in the future. This is why there is something called the forward PE ratio. You can't know for sure how much money the company will make in the future. So the number used is the average of what most experts think will happen. If we go back to Tesla, its forward PE ratio is 123, which isn't as high as its PE ratio. Which means that if you invest in Tesla based on the last 12 months of earnings, you will have to wait 949 years to get your money back. However, experts are telling us don't worry, it's not that long. Tesla is going to be much more profitable, so it's just 123 years. This is why most investors think Tesla is an overvalued stock. But we all know that Elon Musk is an alien, and as he always does, he will show everyone wrong. The price to earnings ratio isn't the most accurate way to figuring out how much a company is really worth, but it is the easiest way to get a general idea of how the company is doing. The company could come up with a product that is better than anything experts could have ever thought of. So if you want to make a better prediction, you need to look at things like the price to book ratio or the PB ratio. It means how much money the company will make if it sells all of its assets and pays off all of its debts. Let's go back to Tesla for a moment. Tesla has a lot of assets, including gigafactories, thousands of charging stations, offices, patents, and many more. Let's say they all add up to $100 million. But a company owes a lot of money, say $70 million. If we subtract what it owes from what it owns, we get $30 million. This is called its book value. So if Tesla has 10 million shares, each one has a book value of $3. To find out how much you will pay for each dollar, divide the stock price, say $15, by the book value of shares. In simple terms, you will have to pay $5 for every $1 that Tesla has in assets. A good price-to-book ratio is around 1. But it can be hard to put a price on things like Snapchat filters or Instagram algorithms. However, analyzing finances is only part of the story. Startup companies, for instance, typically have a lot of debt and not many assets. They may have trouble with cash flow, but they could end up being very successful. So you should never use financial analysis as the only way to tell if a company is successful. On a lighter note, we can get a better idea instead of how well the company is doing by financial analysis. Well, that's basically it. Thank you guys so much for watching today's video. If you enjoyed this, then you will probably learn a lot more from watching this other video, a step-by-step guide to investing your first $1,000. If you click on the screen right now, you can go and watch that. Do you want to learn more on how to thrive wisely? What videos would you want to watch next? Feel free to comment down below. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.